Welcome to Insights. I'm Eric. I want to do a stock market S&P 500 style review today. Not so much in an evolution of the trade, but rather in just a general macro strategy, whether or not the stock market could head higher or it's destined to be lower. It's brought about by this individual's tweet that I saw on social media, of which they clearly said some bullish things, would be at least my interpretation, and then this person felt like they must defend themselves. People were probably proclaiming the market was in a bubble state, and as a bubble state, everyone's in the equity market, and he was suggesting that it's possible that not everyone's in, and the VIX could actually break down further, generating a breakout to new highs. All possibilities. But I think we're not asking the wrong question of whether this is a market that or the right question, whether the market is something that everyone is in, but rather, is it a market that has inherent risk behind it in terms of the cycles? And we're going to have to take a look at the longer term cycles, but inside the matrix for subscribers, even though this information hasn't changed, we're just going to take a quick look here before we head to those cycles. The sentiment and VIX model are located here, here, and here, and they're both in bull phase, and this shows up here with the U.S. stock models in bull phase. They've been both in bull phase since 10.8, and it's one of the reasons why the path of least resistance is up. It's going to stay that way until one of these models or both of these models turn into bear or enter a bear state together. So it's really not a question of whether the stock market can go higher. The computer is telling us it's destined to go higher until this changes. So it's not even really worth arguing whether or not people are all in or not, or if this is a bubble conditions. It's either up or down, and we're up. But let's look at the longer term. From a longer term perspective, let's look at the risks. And this is, I think sometimes we have to ask the right question. It's not whether or not the stock market's in a bubble. Are the risks of continuation extremely high? And I think you have to look at the dividend yield cycle model. This is the 1 through 4 that's shown in the matrix down below in the long-term cycles. And I've highlighted all the bearish readings at 1 point or 2 standard deviations, which is a cycle reading that suggests extremes. The computer can highlight the bulls here, and then it can highlight the bear. And when we look at it, we look at them both at the same time, but we're interested in the bear. And what we can see is in 2021, we're really, the only times that are comparable to this is the 97-98 period, the 87, 1955, which even though the market kept going, we did sell off. The 1929, 1899, of which then the market sold off, and that was capped in for quite a few decades afterwards. So this setup, this reading here of minus 2.24, which you can pull on the matrix, and I will show you that before I close out this discussion, that's a pretty low number. It's one of the lowest ones that we've seen in history. If you step back and take a look at 1 through 6, is something I don't show in the matrix, but it is something that we focus on, and I pulled this in for 1. It really highlights only 2 periods, one in 1929 and one around 1998, or right up into the top of 2000. We're really close to that at minus 1.83. Last month we were there, but now it's backed off somewhat. So this market can continue on, but essentially the dangers would be similar to either 1987 or a major top that's equivalent to the 1929. They would form as long as this number closes below 2, which is not that far away, a little bit higher from here, and we're going to generate it again. This is a combination that includes the very long-term indicators. This one's reliable enough. It doesn't include the 5, 6 models that are here. It's 1 through 4. It's already warning us. So the question is the market favor continuation? The answer is no, because it's already cyclically extended relative to the dividends. Does that mean it's not in a bubble state and can't continue to go up? The answer to that is no, it can continue to go up as well, because the models are up, the sentiment models and the VIX model, which is the dominant timing models inside the matrix, they continue to be up as well. A market in an extreme state or heading towards an extreme state can visit there for a while, but the fact is even if we go up here for another couple months, this market is setting cycle readings that would suggest a severe decline is possible and probable. So whether or not, I guess if you're a day trader and in and out all the time, it's not a big deal. But if you're holding your money longer, you're a longer term investor, or can't move your money because you have your size of your accounts are too big, or you're running funds or pension funds which can't jump in and out of the market like with that much ease because of liquidity restraints, this is an extremely dangerous market. So to suggest or even imply that this market is not concentrated enough and therefore somehow it's safe, well, yeah, that I don't think I would set that characterize the market as that either. So if we head back to the conversation, I'm sure whether or not this could go down, yeah, we could go, the volatility could go down, the market could go up, and things could get even crazier. We'll watch down here inside the long-term cycles and the dividend yield cycles here, so keep an eye on it if you're a subscriber. This is basically open content for now, so we'll address this as it comes. We'll talk about it more if the readings come back again. But please be warned that this is a concentrated situation here. The cycles are extremely concentrated. These long-term dividend cycles go back into the 1800s, as long as they produce records of earnings and dividends, which the railroad stocks did. So you have it through about 1825-ish, 1850, 1825. So you can get an approximate valuation of what the market was thinking in the moment and compare them over time, and that's what the computer does. So this is not a safe market based on probabilities, but that doesn't mean it can't go higher. So we will talk about this more if it happens, but I think it's a discussion that maybe will help out as everyone sits around and enjoys an evening on the weekend or has some thoughts about the market this weekend. If you have any questions about the future or timing and direction or anything that we talked about here today, contact me directly through the blog or leave some comments below this video. I'll leave it open so everyone can think about it and pass it around. If you have subscribed to the YouTube channel, that's great. And if you subscribe to the Matrix, great. And we thank you for that. If you haven't done so already, consider signing up. This is a good place to have good discussions, and the computer is pretty objective, and really to navigate through this in terms of like understanding price and time cycles, you can't interject your emotions, and you really have to stay off social media in terms of even having discussions with everyone else. There's too much opinion out there to be really any use from a standpoint of trading and investment discipline. So thanks for watching the video, and have yourself a good weekend.